All right, just getting back from the gym and settling in here to Composer's back end. And what I wanted to do today is to show a new symphony that I've created. And the way this came about is this. Essentially, my balanced alpha 3 times leverage, which is somewhat similar to the hedge fundy strategy that a lot of people are aware of. I was writing about that in like 2019 or so, and on Seeking Alpha, and I ran it with Motif. I ran it with Folio, and now I have it with Interactive Brokers. It's been transferred about. But a lot of times when you see these type of risk parity negative correlation strategies with leverage ETFs, a lot of times people in the comments section will say, well, there's inflation, it's not transitory, and we could go into superinflation, hyperinflation. And if that's the case, I don't want to have long-term bonds. So I don't want to own TLT, okay? And TMF is the leverage version of TLT. So a lot of times people are hesitant to hold balanced alpha long-term because of this specter of inflation, be it transitory or not. And so what I built here is I just called this one 3 times leverage inflation buster. But let me actually scroll through this whole list here before I get to that. So you can see here, these are the annualized returns of a lot of the funds that I built. I built actually 75 now. I pulled some basic ones in that Composer provided. I think there may be 10. So if you minus the approximately 10 from Composer itself, that would be 65 self-created. And you can just see like what the annualized returns would be on some of these: 129.6, 35.9, 66. And actually, let me go to the balanced alpha. So the balanced alpha, the one I referenced right now, would be a 27.7 annualized return. We're going down to a 58.1. And the one I'm actually running in Alpaca is this one. You can see live trading here. So just scrolling down another 86.9, 141, 93, 91.6. I think that one is actually one of Composer's equity bond switchers. I think that's a Composer one. Scrolling down 71. You see the 48,000% one. That's the meme stocks, 81.3, permanent store of wealth. 111.16. It's a market timing one, 118.3. So, yeah, I'm up to, I think, 75 now, which is interesting. But let's now go ahead and look at this one, 3 times leverage inflation buster. So many people, when they talk about inflation, the question then is, okay, so what do I own? Do I own tips? Do I own physical gold and silver? Do I own real estate? Do I take out debt on real estate? There's a lot of different ways you can play inflation. That's not the purpose of this particular video, but one of the main ways that many people agree on how to confront inflation is through gold. And so what I've done here is I created a grouping, 50% equities, all leverage here, TQQ, Q, and UPRO. And then I have 50%. So instead of the bonds, instead of going like long-term bonds here with TMF, I'm going to 3 leverage gold funds. There used to be a 3 times leverage one, and that no longer is around. So UGL is just like the gold itself, and then the 2 gold miners. And from my understanding on the gold miners, you're going to get higher highs and lower lows on those when gold spikes. So let's take a look at it. Let's just run some back tests here. Doing a quarterly rebalance on this. And so these are grouping here. So you have, like, I created a group here. So if I added another one here, it would just break this down and do all the calculations on 50% of the overall portfolio with an addition. So that's the advantage of creating it as a group as opposed to individually weighting it. And same with this. So say, for example, in the next few years, there actually is a new 3 times leverage gold fund. I could just add that into this mix. And then those 4 funds would balance out to 50%. So it's doing it all for you. But yeah, let's do some quick back tests here. Okay. Doing some thinking there. Here it comes. Okay. So let's get rid of all the other. Oh, there it is. Okay, run. Okay, 35.7. So here it is. So this is going back, let's see, this is going back to 2016, January of 2016, which is interesting. And so you're going back a good 5 years on this fund. I mean, you can see, wow, like look at February, March of 2020. I mean, it almost went equal that to SPY. It was way above it, almost met it there. So let's look at some of the metrics here. So both have done well, right? I mean, you bought, you listen to Jack Bogle or JL Collins or any indexer, you bought SPY, you've done well. 17.2%, you've 143.1 over that time. But if you've done something like this, you've compounded capital at 35.7. Sharp ratio is lower than SPY. I mean, look at its standard deviation, 60.9 versus 18.3. I mean, look at its max drawdown, 68.7, so almost a 70% drawdown at one point. And again, that's probably going to be in March of 2020 versus only a 33% drawdown SPY. But look, its CalMAR ratio, which is a measure of risk-adjusted return, the annualized return divided by the max drawdown for the selected time period. So you can see its CalMAR ratio is above SPY, whereas its Sharp is beneath it. And you can see here if you scroll down, so you'll see the percentages, and you'll see it's quarterly. So it'll be, yeah, let me go back. So you can see like 25. It looks like July 8th might have been. I'm trying to find like the perfect. Yeah, here it is. It looks like July 1st was the rebalance. So on July 1st, 25% UPRO, 25% TQQ, 16.7 on the gold funds. So that's the rebalance. And then where it would be today is obviously not that even. So it's close though. 27.3, 27.5, 15.3, 13.7, 16.2. So UGL has outperformed the other two, NG and UGT and JNUG. I do some options on these. I actually have I think a put on JNUG. I'd have to pull up my TD Ameritrade to see that. But so that's the 5 year. Let's look at the 3 year. Let's look at the 3 year, and then we'll do the 1 year. Okay, so scrolling down here. So 31.4 versus 18.2. Same thing, lower Sharp ratio, higher max drawdown, higher or lower CalMAR ratio. But again, I always repeat this, but and actually I said it in a video, and then a guy posted on Twitter, so I've just kind of added as a quotation into my monthly newsletter, my monthly essay with Seeking Alpha, which is the ability to deal with volatility is a superhuman power in investing. And so again, you've dealt with, and you can look at the green line. So you see that you were all the way here, and you went all the way down. So you went lower than SPY, but look where you are now. You've outperformed. So can you endure this to get this greater outperformance? That's the question. A lot of people say, oh yeah, of course. But it's hard to do it when you're hemorrhaging tens of thousands, hundreds of thousands, millions of dollars at the time. It's hard to hold the line, but you can see what happens when you do, and you have that kind of discipline. But yeah, 31.4% annualized return. And let's do 2 more, 1 year and then year to date. So it looks like the 1 year SPY has outperformed over this last year. um, 34 to 26. And that's because gold sold off over the last year or so, I think. So it's probably dragging that down. And let's do year to date. It's probably going to be the same thing, would be my guess. Yeah, and SPY has outperformed year to date. So you're at, only 11% here to 35.6. Gold's definitely sold off. But again, when you look at these things, you definitely, I try to think like the further back you go, it's better. So, if you're going to come, like if we did the first one, I think that's something I would, even let's go back like to 14. Let's go back even a little bit more if we can. Now, if the ETF wasn't created, then you're going to get an error message and you'll be able to find the date. No, it was. So again, unless we're going back now, January 1st of 14. So 16.9 versus 14.4. So it's a little bit of an outperformance. Again, but this is something where if you didn't want to run balanced alpha because of the long-term bond issue, but you wanted to run something that had risk parity, negative correlation or low correlation, this is something maybe to look at. And I'm actually hoping to run, I'm working on a refinance on a piece of real estate, and I'm hoping to use the cash out refi money to run these 75 symphonies equal weighted, which I think will give me a phenomenal Sharpe and Kalmar ratio. But we'll see. I'm still in the process on that. Right now, it's still not multi-symphony, but that's one of my goals of from now until the end of 2021. So we'll see. But yeah, I hope you found that informative. And for those of you out there who look to run leverage, look to run it with risk parity, but also are fearful of TMF because of the bond exposure, this might be a wonderful fit. Like and subscribe, and getting a lot of new subscribers. Appreciate that. I'm hoping to do a video or two a week, just, portfolio updates, anything that comes across my desk. All right. Take care. Ciao.